Hello and welcome to today's Fat Tail Daily video. Now, a week ago we started doing these daily chats about that day's article, and I'm pleased to say I'm joined today by Ryan Dinse for your second chat about it. How you doing,
Yeah,
Ryan?
hey, Willie. So yeah, see if we get better with time with these things.
Yeah, well, I was going to say last week you actually talked about is the AI trade ignited. So let's just start. You actually make a really interesting point in today's piece. It's a really good read. But let's just revisit last year. You said that is the AI trade ignited,
Mhm.
and Nvidia's results came through, and they didn't provide a clear signal for that trade. So I was just going to say, have you got a quick update on that? Given this
Yeah,
uncertainty, how do you suggest investors approach the AI sector in the coming months? Is it something to leave
yes.
alone, or is it?
Well, yeah. Look, I suppose So last week we came off the back of the Fed in the U.S., the central bank in the U.S., saying basically pivoting. We talked about it as a pal pivot that interest rates are coming, and that seems to be pretty accepted across the board now. Markets in the US are pricing in 1% cut by the end of the year, which is quite significant. On an anecdotal note, I managed to get my bank here in Australia to cut interest rates for the first time in a while. So clearly, everyone's positioning for interest rate cuts. So that's the first point. So that was the story of last week. And we sort of hypothesized last Monday, if you recall, Woody, we said, well, look, interest rate cuts are generally good for tech stocks. And part of the AI trade or part of the tech story is when interest rates come down, the valuations of tech stocks go up. And so we hypothesized last week that Nvidia's results on Wednesday might provide like the 1-2 punch for the reignition of that trade. So if Nvidia came through with like an earnings beat or a revenue beat and expressed optimism on the AI story, then you might have those dual headwinds of interest rates coming plus AI build out continuing, and we might get a reignition. That was the hope, but it sort of played out weird because when Nvidia made the results on Wednesday, they did beat earnings and guidance to a degree, at least from the analyst expectations. But the stock fell. It was one of those moments where the market was maybe, on the whole, pricing in even better results.
Mhm.
And then there's also the devil in the detail. There's some delays on some of their new chips, the Blackwells coming through. So people will look to the future and say, well, those delays might feed into future earnings. But the big takeaway, on the Thursday, sort of the market fell because like they didn't get the sugar hit they were hoping for. But then on Friday, everything bounced back up pretty strongly. So it was like people had time to digest the news and say, oh, well, actually, this build out is still roaring ahead, and it is. You know, the Nvidia is still uh, increasing earnings every quarter. They're still building out these data centers. There's some other results I saw last week from other AI companies that suggested traction was still forging ahead. So other parts of the business in some of these tech companies were actually slowing down a bit, but the AI specific sectors were still growing. So they were the growth engines of these companies. So it was a little bit of a mixed bag. It's sort of like, on one hand, the AI build out is continuing. On the other hand, interest rate cuts generally can be good for tech stocks, but not if they're signaling a real slowdown in the economy. And some of the results from some tech stocks were showing signs of that, that maybe other parts of their normal business were slowing down, could suggest economic weakness. So we had that sort of decline on Thursday, the bounce back on Friday, and we'll see where that leads this week. But taking a step back, I think the two takeaways for me were, look, the momentum trade behind AI is maybe not going to reappear straight away. You might have to be a little bit patient, but you do have those tailwinds of interest rate cuts, and you do have to date this AI build out just continuing no matter what. And I think that'll continue no matter what happens in the economy.
Yeah, I think AI generally, just one more word on AI. I think it is generally a theme and a tech which is much like the internet was back in the late 90s, where the momentum trade in internet stocks really petered out in the early 2000s. But I mean, if you just look what happened over the next 15 years,
Yeah.
things got built out, and it's probably you're looking at a similar thing, but you just got to pick wisely.
Yeah, that's exactly right, and it's got that level of uncertainty in it as well. If you remember the dot-com era, no one knew who the winners would be. Google was a garage startup in the late '90s. Still, Facebook didn't exist until 2004. The iPhone, or even Apple and the iPhone resurgence, only came in 2007. So everyone
Yeah.
thinks the dot-com boom of '99, 2000. There was a heap of money made between '97 and 2000 in that initial stages, but then there was 4 or 5 years after the bust where people were still trying to work out, well, how do you monetize the internet? What are the new business models? But today we live with them all the time. We do banking online, we do shopping online, we stream our TV. So the internet reality did come. It just took a little bit longer than what the early stages think. And I think the AI story will be, to an extent, similar, but I don't think we'll be waiting 2 decades or a decade for it to happen. I think it'll be, you've got to remember the arc of tech progress is exponential. And
Yeah.
so the benefit of AI and stuff, there will be delays, like with the Nvidia's chips and other types of chips. But you're talking, in 5 years, I think AI will be as ubiquitous in our lives as the internet is today.
And the exciting thing for investors is that, we don't know who they are yet, but there will be some immense opportunities
Yeah, that's
within
the
that
exciting
sector.
part, isn't it? Trying to work out the
Yeah.
lay of land, and look, that's part of the reason for the uncertainty as well. There
Yeah.
was in last week's Nvidia results some question marks of, all right, we know Nvidia is making money right now because of this build up, but who else is going to make money? And that the
Yeah.
market right now can't figure that out. And they're a bit worried that it's a one-trick pony in the sense that right now all the profits going to Nvidia, but where's the applications and all that other stuff? But that will come later on. And like you said, the exciting part for as an investor is trying to work out, right, well, what industry can be disrupted by this, and when that happens, where does the profit accrue? Who takes the gain of that, and then what does that lead to, the second and third order effects? And that's the exciting part. But yeah, it's not easy, not easy to do.
Well, let's talk about some second order effects, because you zero in, you go from the bigger picture, then zero in on a potential trap that most people probably don't think about when investing in tech. Because like you said, when there's a potential rate cut on the horizon, the natural reaction is to get bullish on tech, but not every tech company is the same in a lower interest rate environment. Do you want to expand on the point that you were making a little bit more?
Yeah, so we sort of went in the story from that bigger picture AI stuff, just to give an update on that, to the fact that, right, interest rates are coming down, and so if you're looking at tech stocks, you have to be a little bit careful because, as you said, generally reductions in interest rates, as long as it's not a recession or something like that, but reductions in interest rates usually make the valuations of tech stocks go up, generally because just the present value of their future cash flows gets re-rated higher, and you get a little bit more risk taking coming into the equation because people are looking for more yield. And we talked about that last week. All that trillions of dollars sitting in these money manager funds, they're happy earning 5%, but when rates come down to 3%, they start looking for better opportunities because otherwise inflation just eats up all the returns. So you got that dynamic, but what I tried to say in today's piece is you have to still understand the business you're investing in, the tech business you're investing in, because you have to understand its profit model. And one of the interesting things about a bunch of tech stocks, and I use the example of Airbnb, is that this high rate environment has actually been good for certain tech stocks. Like
Yeah.
Airbnb actually earns interest on the money it holds from its customers. So when you book a holiday on Airbnb, you give Airbnb your money, but they don't just give that to the property owner. They sit on it. And while they're sitting on it, it's earning all this interest for them. Fine, you might think, all right, well, that's a little bump to their earnings, but it's not a little bump. Last quarter, it made up 40% of Airbnb's earnings. So you've got this huge global company, Airbnb, worth 75 billion, and 40% of its revenue right now is coming from money sitting in the bank earning interest, which is great, which is a nice little business model. But then you have to think, well, if interest rates come down, what you have to take that into account. Is that going to affect their bottom line? And it could do. That's not the only factor, of course, because you've got to think, well, if interest rates come down and we don't get a recession and people take more holidays, then that might also be good. But the point I was trying to make is you have to understand the outsized effect of that on Airbnb. And there's other stocks like that. Robinhood's another one, the share trading app. They basically, for a long time, they did, I don't know if they still do it now, but they used to do free trades, free share trades. And you think, well, how do they make money? They made money purely from sitting on the money in the bank. When you were like buying and selling shares, from time to time, your money would just be sitting in cash when you're waiting for the next share trade. And Robinhood would just make the interest on that. And
Well,
that makes
it's like you say, they're almost not tech stocks; they're money managers. That's
the
what you
money
say.
managers. Yeah,
This
that's the
kind of
thing.
reminds
Yeah.
me of that film, the founder, when it was about the story of Ray Kroc and how he came across the McDonald's brothers in
Yeah,
the early
yeah.
1950s. And the key moment, which is quite poignant in that movie, was that when Kroc realised I'm not actually in the food business, I'm in the real estate business.
Yeah.
It's kind of reminded me of that.
That's a great point, Woody. Yeah, because and there's plenty of companies. I think Bunnings. People used to think, well, Bunnings was a hardware shop, but it was actually a real estate company, like
Yeah.
you said. And even if you think about like Warren Buffett, so what's his business model? He is actually Berkshire Hathaway is set up as an insurance company, which is a similar principle. So, what does an insurance company do? It collects little bits of money up front, hopefully to cover some event far off in the future. But how Buffett made his money is you're giving him the money and he's investing it, and so he's getting the money up front and he's making enough to cover the future liabilities and make a big profit. But he's doing the same thing. He's using that free money that people are giving him up front, and he's smart enough to make more and cover the insurance liabilities in the future. So, yeah, it's just interesting to see the point is what is the business and how does it actually make money? Is it a tech stock that's relying? Is Airbnb a travel company? Well, it is to a degree, but it's also a money manager, as you said. And look, in theory, there's nothing to stop them putting it out of cash. They could put it in stocks if they wanted as well. That might be good, but it might also throw up risks for you as well. It's like an unregulated money manager in a way. So, yeah, I think understanding the business and how it's making money is, a
Well,
key.
it's that time old lesson. Know what you're investing in, right? That's the whole point.
Exactly. And I just thought it was interesting because I've been saying for a while, interest rate cuts are good for tech stocks. But when I was looking at certain companies, I thought, well, yes and no. You have to understand the tech stocks you're looking at. And I think that was just a good example. Just to me, it was just an interesting story and an interesting way to look at a tech stock, which at face value is one thing, but when you look deeper, it's actually, something a little bit, or maybe like completely different in some cases.
Are there any other tech companies that might be similarly affected?
Robin Hood's one. There are a few others. There's one that's not a listed company, but is a pretty interesting company called Tether. Now, Tether is a stable coin
Yep.
that actually it holds US treasuries. So it holds the debt of the US government, right? And it's one of the biggest holders of US treasuries in the world right now. So stable coins, if you recall, are like cryptocurrencies, which aim to hold a one-to-one value with the US dollar. And the benefit is you can use them on the blockchain and send them around for almost free globally. And Tether's built a business around this very fact. Now, the stablecoin itself doesn't earn any interest, and Tether has $100 billion worth of stablecoins out there. So who's collecting the interest? Tether is. And Tether, which is a company that for years was sort of maligned by the media and everyone said they're a fraud, they actually make more money than Goldman Sachs, only because people are giving them money for these stable coins and they're just collecting the interest. I think they made 4.7 billion last quarter. They make it equates to, I think it's $55 million per employee. It's got one of the best revenue per employee metrics in the world. And they're a stable coin tech company, I suppose, a crypto company, and they're making insane profits.
So but I guess the point is when interest rates change, that it changes the dynamic of that business.
Correct, yeah, and that's the whole point. So what you'd have to worry about or think about if you were an investor in Tether, which you can't because it's a private company right now, so you can't. But the Tether management would have to be thinking, do we just take less? Do we take 3% instead of 5%? Or and this was this thing that people were questioning about them in the past was what were they taking bigger risks with the money that they held? Were they putting it in gold and Bitcoin? There was a rumor a few years ago that they had a big exposure to Chinese real estate because of the high yields on offer. And it turns out that they didn't, and a lot of it was just rumors, and you get a lot of that in the crypto world. But that's something you have to be aware of. If a company's making money from interest at 5%, money in the bank might be fine. But will they take more risks with it if we go down to 3% or 2%? And if they do, will you know about it? Because do they have to disclose it? So it's an interesting fact of these cash cow companies that make money from money up front. But what will they do with it? It's something to dig into when you're doing your stock research, just to understand what the risks are and the opportunities as well, I suppose.
Cool. Just final question. What are you looking at this week for the week to come?
So this week, basically looking to see how we follow through on some of that AI stuff because it was late last week. Looking at Bitcoin, Bitcoin seems to be chopping around a little bit, declining a little bit. Seems to be we're in a bit of no man's land. I wrote last week it's part of that debasement trade along with gold, and I think that is over the medium to long term is going to be the the way it plays out. But in the short term, it seems to be going up a bit, down a bit, up a bit, down a bit. So I think it's really looking for a direction, and it could break either way. Knowing Bitcoin, when it decides to break, it will probably break hard. So I'm trying to look at what's happening there. On the positive front, I can see that a lot of whales, who are the big buyers of Bitcoin, they are loading up still. They're just continuously buying. You've got Michael Saylor, who heads a company called MicroStrategy, who's in the process of raising $2 billion to buy more Bitcoin. And that's a really interesting story, which we won't have time to go into today, but something I'll probably write about in the future. But he's just adding more Bitcoin to his company's balance sheet every chance he gets. So you've got that potential. But on the flip side, the price does look a bit weak. So you've obviously got some sellers coming in, and I'm also noticing you're getting a lot of paper selling of Bitcoin. You're getting a lot of activity going from the spot market to the derivatives market, which suggests there's a lot of Wall Street games being played with people selling stuff they don't own, trying to just lock in a profit. So, but that's one of the challenges for Bitcoin to overcome. So it has to be able to take that kind of stuff on. So we'll see what happens.
Cool. All right. Well, we'll leave it there. We'll catch up next Monday and see what played out this week. See what you got right, what you got wrong, and what you're thinking about then. Thanks,
Okay,
Ryan. Much appreciated. As always, if you're watching on YouTube, please do subscribe to our channel. We're going to be uploading a video every day with an interesting new take on the market from our various editors. And if you're on the Fattell Daily website, do sign up to our free daily email, and you'll get our latest insight free each day in your inbox. That's all for today. Thank you. See you soon. Cheers, Ryan.